Good morning, everyone. Joe Glauber just gave you an overview of the global economic situation in the macro sense, and my presentation is going to focus on price formation in the futures markets and also volatility and the various trends that are impacting those issues. Some of these will be macro and some of these will be rather micro. This is a chart of volatility for the past 10 years, and it's a chart called Implied Volatility, and without going into too many details, it's essentially a reflection of traders' expectations of near-term price variability, or volatility, as you'd call it. And what I want you to look at is in the early year of 2005, we had very low volatility, ranging between 20 and 30. And then in the food crisis years, 2007, 2008, you see a very large spike up to 80. And that was followed by successive smaller, we'll call them crises. They're mostly political events and so on that impacted food prices. So you saw those in late 2009, 2011. And then for the past 3 years, you've had relatively low and stable prices and relatively low volatility. But despite the stable prices, you can see where that yellow arrow is, that there's still volatility in the markets that really can't be explained by just the low and stable prices in the range of 30 to 40, as you see on the right-hand side of the graph. So these are the structural trends that I'm going to talk about. There's just 4 of them, really. Globalization, liberalization, computerization, and then I couldn't find the rhyme for the last one, so I just call it outside factors. These are exogenous events, headline news, we call it, of things that happen on a day-to-day basis. Now, in my presentation here about globalization, which means many different things, but essentially what I mean by it here is the increased interconnectivity among countries, increased market access. Market access has been improved by the lowering of trade barriers, such as tariffs, quotas, and so on. So you've seen this surge in trade for the past probably 20 years. You could go back to 20 years at least, probably 25 years, but we're focusing more on the last 10. So not just goods and services, but also capital flows. And I think that's very, very important to look at the this huge galactic swirl of money that now surrounds the globe. And with the globalization, you've seen growing incomes. Growing incomes has resulted in larger demand for foodstuffs, among other things. So to sum up globalization, I think you could say that it's basically helped create more demand for the foodstuffs that AMIS covers. Liberalization goes hand in hand with globalization. But in this case, what we're really focusing on is the reduction of these price management systems, particularly the European Union, which under the Common Agricultural Policy for decades was producing more than it could export through price supports and various means. And we saw that change to a different system so that markets were determining prices in Europe as opposed to these price support systems. Also, South Africa saw the elimination of its single marketing board called the maize board, which completely controlled all the flow of corn and wheat in the marketing system of South Africa, and it went to a free market system. So with these with the establishment of freer markets, with freer markets, you've seen the establishment of many multiple domestic futures exchanges. China has 3 exchanges that are very vibrant. They have some of the largest trade in the world. India also has several futures markets. It lifted its ban rather on futures in 2006, I believe. And with the establishment of these futures exchanges and markets, you've seen all sorts of ancillary services come to the country, such as credit facilities, farm advisory services, which has helped to grow the production in the countries. And along with that is also technological innovation, and I don't mean computerized technological innovation. I'm talking more about improved farm practices, seeds and so on, improved storage. So with liberalization, where the producer produces for the market as opposed to the government, you've seen a huge supply response. I think one that really fooled experts who thought it would take years to rebuild grain stocks in the world, but with free markets, it doesn't, because the producers are really responding. And if you look at agricultural markets, they are really the only market that is so quickly renewable. That's not true in metals market, and certainly not true in the oil and gas markets, which have much longer term commitments of capital. So as important as globalization and liberalization are, I think the computerization of markets has been just transformative. It's given the whole world universal market access. You have instantaneous information and transactions. I used to trade in the Chicago Board of Trade in the pit, but if I weren't trading in the pit and entered orders over the phone to the pit, it might take hours to find out whether your trade was done. So if you think about that, if you're worrying about whether you're long or short, whether you bought or sold, and at what price, you're not trading. You're just waiting to hear about your trade confirmation. So when you have an instant trade confirmation, then you can go ahead and trade again and again and again within minutes of each other. So that has really boosted volumes on all of these exchanges through this computerized process. And along with that, you've got what's called either automated trading or HFT, which is high frequency trading. They're similar, but not exactly. And the automated trading could be simply a computer program that detects anomalies among various markets and takes advantage of those things. It works without human intervention whatsoever. High-frequency trading also is a system that's looking for millisecond differences in prices. So along with this huge computerized world we live in, this has facilitated cross-border transactions, and also, more importantly, I think, is cross-asset class. So when you've had turmoil in various markets, such as the currency markets, such as the equity markets that we've seen, if someone is managing a portfolio of various equities, fixed income instruments, plus commodities, which is very common, you will see switching in and out of those various commodity sectors or asset class sectors, which may have almost nothing to do with the supply and demand that Joe was talking about. So then finally, I'll talk a little bit I just mentioned some outside factors, these currency rates and equity markets. And when we've seen volatility in the equity markets in the US, we've seen volatility in the grain markets as well. They're simply not separate anymore. Then inflation expectations also play into this. And as you know, some countries are suffering from inflation. who've seen their currencies depreciate, and then you've got the developed countries that are worried about deflation, especially in commodity price and dollarized commodity prices. So there's so many different cross currents that are affecting the markets altogether. And then finally, of course, political events, which happen without warning usually or notice, and can so often impact primarily the energy markets, but then that has knock-on effects with the commodity markets. So I'm going to show you the next slide, which I think kind of sums up what has happened to the transformation of these markets. And I'll have to get out here. This on the left? This doesn't work, right? Does this work? No. Well, on the left is the soybean pit in Chicago, what used to be the soybean pit. Oh, good. I get to be an MC. All right. Sorry. On the left, that's the soybean pit of what used to be the soybean pit. All these traders, all the paper on the floor. These were orders or something that got filled, just thrown out. And what you can see here is all of these traders are trading one product. One product. It was very rare for a trader to go into the soybean pit and then run over to the corn pit and trade corn and then run to the wheat pit and trade wheat. The same people would stay in the same soybean pit for years in the same spot. So now, there he is. I don't know who this is, but one trader looking very bored, but he's surrounded by screens and order entry systems that allow him to trade multiple markets. One person with multiple markets. Maybe he has a machine running right now that's trading all these things for him. I don't know. But with this slide, I'm concluding because I think you can see that that really epitomizes how trading has changed and therefore how price formation has changed and how volatility can arise even when you think that there's nothing going on. Thank you.
And thank you very much. Let's keep you up here for a few questions.